Welcome back to Andy the Banker Show. We have a lot to discuss today. I've ended up buying more Google stock, so I want to share my thesis on this particular stock. We have to discuss what's going on in the stock market right now and the freaking mid cap to small cap stocks that's just going haywire. And we need to discuss about data centers. Data centers is one of the biggest talks in the stock market. Let's get started. I bought 9 shares of Google today, and I'm gonna continue buying Google. Here's why, you guys. The company right now, the business model is growing. It's YouTube is growing, Google Cloud growing, ad search business still growing. Yet this is a company that is extremely undervalued. It's trading at a PE ratio of 23. It has a lower PE ratio than Nike, lower PE ratio than the freaking S&P 500. And in my honest opinion, you guys, this company is better than at least half of the companies inside the S&P 500. And not only that, I actually do think that one of these active investors will get into Google just because of how enticing the company is. It is at a 23 PE ratio, trading at very nice, and the company is growing. I do think this issue of the lawsuits that's behind them. However, there's a new issue that is with Google, which is that the capital expenditure in Google is going up and up. Or they're currently spending $75 billion just on creating new data centers and on AI. And there's a big need for it because as as we go in year over year, we're creating more data as humans. There's more younger generation creating data, and not only that, we now have artificial intelligence creating data itself. So because of that, you need a place where you can store all that data. Where else better than Google Cloud? Where else better than Microsoft Cloud? So that's my thesis on the Google stock. I will continue to buy this stock, especially if it's trading at 23 PE ratio, and especially if it's lower than the S&P 500. Now, the second thing that I got to discuss with you is this thing about the small cap to mid cap companies. All right. This last week, 2 weeks, or just the whole year itself, you guys, you have smaller companies just going crazy up. All right. You have companies like Robinhood up 400%. You have companies like Dutch Bros, 200%, right? Hims and Hers, 500%, you guys. And these are not small numbers. These at this point, I'm like thinking, how much higher can these stocks go? Because they've already gone up so much. Now, I had somebody on my TikTok tell me, Andy, why did you not buy these stocks? If you're bullish on Robinhood, if you like Dutch Bros, which I do, I love their products. Why did you not buy into them? Well, I'll tell you why. These companies were already up like 80% or over 100% at the time that I wanted to buy them. So at that moment in time, there was a lot of risk involved because what comes up does eventually come back down, especially when you go up, 300%, 400% in a single year. Now, those type of movements does not happen often, and especially with these many, like so many companies all going up at once, that is definitely not normal at all. One of the theories that I have is that the money that would have went to the Magnificent Seven, that money is being allocated to the 493, the biggest 493 stocks, and to these smaller and mid cap stocks. However, I still believe in the Max 7, the companies like the Microsofts, the Googles, because these are slow compounders. And anytime we have a moment of uncertainty, I just have a feeling that investors will be flocking back into the Max 7. And when that happens, I will be there waiting for them because these are companies that are compounding machines. These are companies like the Microsoft that can make money during a good economy and a bad economy. And that's the key part, you guys. There are certain companies that's going up right now that in a bad economy, I really don't know if they can keep on going higher in a bad economy. Now, one thing I want to make it very clear, you guys, is that I am not bearish on these companies. Now, these smaller to mid-cap companies like the Dutch Bros, the Robin Hoods, the Hims and Hers, I actually love what they're doing, the products they're coming out with, the innovations. I love it. My only question is, are they really worth 300% in a single year? Or do they deserve a 400% stock gain in a single year, 500%? Because that is not normal, you guys. That rarely happens. That is very, very unnormal, I should say. So that is my main question. Not that these companies are bad. It's just that, are they good enough to have this big of a performance is my biggest concern for the stock market. But besides that, I love what they're doing. I see the earnings report. I'm not lying to it. The earning reports, they have been great. All right. I'm not going to lie about that. But again, my question always comes down to, is it really worth, will I buy into Hims and Hers when the company has gone up 500%? Is it more likely that the company comes back down to normal levels of, like, let's say 100% year over gain? Or is it going to go crazy and go 700%? Right? Will it keep on going higher? And my personal opinion is just that's just not it. I don't think it's going to keep on going to 800%, 900%. I could be wrong, but that's not the risk that I'm willing to take. Now, on other news that's so interesting in the stock market is this news of the data centers, you guys. And it's one of the reasons why I have been investing so much into Microsoft and Google, because these two are data center plays. And I honestly think in the future, data centers are going to be so crucial to the stock market, because all these data that's been being created, you have to store them somewhere. There's so much data that's being created every single year that the supply, I'm sorry, cannot keep up. And that's the issue they have, which is that even Microsoft has stated themselves that they don't have a demand issue. The demand is increasing year over year. The issue is on the supply. They can't seem to create more data centers than there is supply. As a result of this, one of the interesting things you are seeing in the stock market is that you're seeing data centers move from metropolitan areas that's close to the cities, that's where the actual data is being created, to places like Texas, right? And the main reason why they're moving to Texas is because that's where the power sources are. These data centers, specifically the AI data centers, take so much power that you need a strong source of power. As a result, they're moving to Texas. And what's surprising about this, to me at least, you guys, is that 20 years ago, to me, Texas was a place that was known as a place of crude oil, a place of natural gas. It was not known for renewable energy. When I thought about Texas, I did not think about solar panels. I did not think about wind turbines. However, it has come to a place where it is actually being known for renewable energy, and how it's becoming a dominant energy powerhouse in the United States. And as a result, a lot of these data centers are flocking over to Texas. The last thing I want to share was about tariffs that Mr. Trump has implemented into the US. One of those tariffs being 25% tariffs on imported steel and imported aluminum. Now, what's crazy about this is that a lot of the car companies are being impacted. The Ford, the GM, and it makes sense. A lot of their car uses those materials. However, there is one company that doesn't seem to be getting impacted as much, and that company is Tesla. All right. Tesla, according to my knowledge, uses a lot of steel, uses a lot of aluminum. Yet, this is a company that seems to constantly have this cult like following where people believe in the future of Tesla instead of believing in what they're actually showing you. For example, Tesla talks about full self driving. I haven't seen it. I drive a Tesla myself. I have to have my hands on the wheel for it to work. That to me is not full self driving. Specifically, when I see Waymos around San Francisco driving by themselves. And I think one of the biggest issue that I have with Tesla and why Tesla full drive self driving is not being implemented is that when I'm driving my Tesla, the full self driving uses technology of the cameras. So if the cameras are blocked by rain or by snow, it does not seem to work so well. During a sunny day, the full self-driving is amazing. But because it uses cameras, and when the rain comes down and blocks the cameras, it can't see so well. So I'm really curious to see how Tesla is going to fix this issue of full self-driving with cameras. Are they maybe gonna change the whole technology, or are they gonna stick to the guns of we're going to use the cameras? But we'll have to see how this plays out. And with that, you guys, thank you so much for watching. I'll see you guys on the next episode. I'm gonna continue buying into the stock market, just dollar cost average my way in. I'll see you next time.